Hey, it's Steve Ryder with Keller Williams and Ryder Realty Group here today with more real estate conversations.
And this is Genna with Supreme Lending, taking the emotion out, and let's talk about some logical solutions in today's market.
I like it. Let's do it. I get a lot of questions, Genna, about closing costs and what are closing costs. The misconception with a lot of folks, especially people that we work with that haven't bought and sold a lot of homes, right? They don't understand the closing cost portion of it.
Okay.
A lot of sellers think that closing costs are their costs, and they're not. The closing costs are associated with the buyer's loan. You know, all the things that go into getting a loan and paying the attorney's fees and all that other stuff. And anytime a seller has to pay those, it's negotiated as part of the contract. So how are closing costs affected by the rates, the higher rates? Because most people don't know what goes into that.
Yeah.
So explain that a little bit.
So quick kind of touch point in difference of closing costs real quick and where closing costs come from is I always tell a client your down payment is your contribution towards the purchase. Your closing costs are the bills that have to be paid to purchase.
I like it.
Okay. So homeowners insurance, property taxes, closing attorney fees, underwriting and processing fees, all the bills that have to be paid when you're buying a house versus your contribution towards the purchase price. Okay. Closing costs, it's a yes and no question of whether or not closing costs are impacted by the rate.
Okay.
Okay.
All right.
So one is in a higher interest rate environment, lenders out there know that our consumer's eye goes towards what? The rate.
The rate.
Right. Our consumer, they're looking right at that interest rate. So as the economy shifts, the way that closing cost structure for most lenders can kind of adjust with the economy. Right now, it's standard industry practice to either quote half a point or a full point in your closing costs and origination costs.
Okay.
Okay. When rates are low,
explain what a point is, by the way.
Okay. A point is your contribution towards the interest rate. And 1 point is equivalent to 1% of the loan amount.
1% of the loan amount. Okay. That was my question. Okay. Yeah.
So in today's economy, especially because like your online lenders and things like that, know that that consumer's eye is going to the interest rate, that's where their mindset is. They can charge points in their quote to get their rate lower.
Okay.
Okay. It's all about smokes and mirrors and how they're presenting the information.
Right.
Okay. So in a higher rate environment, you can tend to see interest rates go up because lenders want to be able to quote lower rates. So then the industry standard becomes where you're typically seeing half a point to 1 point in origination costs to help impact the rate for the consumer.
Okay.
If I don't quote any origination costs in my quoting in today's market, my rate will be higher than other lenders that are quoting an origination cost.
Right. Okay.
Okay. It is one of a lender's biggest pain point when we have a client that's looking at costs of mortgages. Because, for example, there's one of the biggest online nationwide lender, Rockets Explode, by the way, where pretty much, I mean, even if you're pulling up their standard website, it'll state these rates are with 2.5% origination, with 20% down, and there's all these stipulations of which that rate is quoted. The important part for the consumer to understand is that there are two main things that you're looking at when you're comparing rates and costs of a loan is what's the origination and what's the interest rate. Okay. The rate, any lender can quote any rate. The question is, what does it cost you to get there?
Right.
Okay. So if you have a client that's only looking at that interest rate number, it could very well be that they're actually working with a lender that's costing them more money because they're charging more in points for the rate that they're quoting, or a lender that's quoting initially a higher rate, but isn't, like, you could still choose to buy down the rate if you so chose. I think that an honest, transparent way of working in the marketplace is to just explain it honestly to the client. Here's your options. Here's how it works. You make the decision of how you'd like to move forward.
Yeah. you got to really pay attention to the numbers.
Mm-hmm.
You know, read the fine print. They always say that. I know I've seen a commercial on TV, and I won't mention the name of the lender, but they talk about giving a $10,000 credit. You probably know who I'm talking about here. $10,000 credit towards your closing costs. And I'm thinking, well, yeah, of course you can afford to do a $10,000 because you're controlling the closing cost.
Well, and you're controlling the rate that you're quoting at those closing costs.
Right. So you can make that up in any number of different ways.
Right.
Which, I mean, it's good marketing. Don't get me wrong. I don't disagree with that. But at the end of the day, the consumer really has to pay attention to what they're paying and what they're getting into with rates and closing costs and upfront costs. And that's why I always say compare and contrast.
Yeah. Just like you can buy down the interest rate to get a lower rate with higher closing costs, you can reduce your closing costs by increasing your interest rate.
Right.